Hello to everyone. Today I am here with Financial Risk Management Part 3. If you are interested to have more videos on banking and finance related topics, please do subscribe my channel. Today we are going to discuss the types of financial risk and the subtypes of each financial risk. First of all, market risk is the risk that declining prices or volatility of the prices in the financial market. So it's one of the major risks. Definitely, market risk has a direct link with the change in interest rate and of devaluation of the currency. Liquidity risk is the possibility of sustaining significant loss due to the inability to significantly liquidate a position at a fair price, particularly in case of financial crisis 2007 and 8 we have faced to dispose of the asset at the fair price. Credit risk is the possibility of a default by a counterparty in a financial transaction, and the monitoring the exposure to credit risk is a function of the probability of a default and the loss that result given default occurs. So basically, credit risk deals with, on one side, with the default and on the other side, with the settlement. Operational risk is the risk of the loss due to inadequate monitoring system, management failure, defective control, fraud, and or human error. We have an example, we can discuss an example if due to any server failure in the banking system, you are not able to make your payment in time and you did not receive your raw material in time. Similarly, if your machinery went out of order, you may not be able to manufacture your goods in time, and it will cause delay for the delivery of the finished goods. Market risk. Now here we are going to discuss the subtypes of each type of the financial risk type. Describe and differentiate between the absolute and relative market risk. Absolute risk focus on the volatility of total return, and relative risk is referred as tracking error, since it is usually measured relative to a benchmark index or a portfolio. So in that case, any variation from a benchmark, you can take the example of any stock exchange index. For example, the return on the stock exchange index is 5%, and you are marked your return minimum equal to 5%. Any variation from that index result is a type of relative risk. Describe and differentiate between the directional and non-directional market risk. Directional risk are linear risk. Explores in economic or the financial variable. Interest rate and exchange rate is one of the examples, because both having a linear relation with the inflation. Non-directional risks are the risks that have a non-linear exposure to the change in economic and the financial variable. So there are a number of things that have a non-directional risk with the economic and financial variables. Describe basic and its sources. Basic risk is the risk that the price of a hedge instrument put option. Now, any change in the price of the risk instrument and any change in the price of the instrument that you have hedged. For example, you have purchased the dollar equal to rupee 300. Now, presently, the market price of the dollar dipped to 250. So how you mitigate? One of the example is either you avail the option or not. If you have availed the option, then you have the provision to mitigate that risk. Describe volatility and its sources. Risk of loss from the change in the actual and imply the volatility of the market price is known as the volatility risk. Liquidity risk describes and differentiates asset liquidity and funding liquidity. Asset liquidity risk, which is sometimes called as market liquidity risk, results from a large position size forcing transaction to influence the price of security. We have the example of 2007 and 2008 crisis where the consumers were not able to dispose of their asset at fair price, particularly mortgage assets. Funding liquidity risk, which is sometimes called cash flow risk, unable to raise the cash to meet the financial obligation. If you didn't able to meet your inflow in time, definitely you will not able to meet your obligations in time. Credit risk describe and differentiate between the exposure and the recovery rate. Exposure is the size or the value of the loss. You can say the limit you have sanctioned or you have dispersed to the customer. Recovery rate is the percentage of the asset that could be recovered from the counterparty. It is purely depend on the forced value of the securities to exposure. For example, if the forced value of the security is 80% of the exposure, so the recovery rate is considered to be 80% and you have value at risk equal to 20%. Describe credit event and how it may relate to the market risk. Relates to a change in the counterparty ability to perform its previous agreed or to the financial obligation. Market prices incorporate change to the credit rating, which can be looked at as both market risk and the credit risk. For example, if you did not meet your settlement in time, it's a part of the credit risk. Definitely, it will affect your credit rating and your interest rate will change. That is a part of the market risk. In this way, you can relate market and credit risk. Describe sovereign risk and its sources. Sovereign risk refer to the risk resulting from a country's action. Source of the sovereign risk stem from a country's political and legal system. For example, the country take the action to increase the tariffs. So if you have made a commitment on the basis of the previous tariff, so it will directly affect your profitability. Describe settlement risk and its sources. Settlement risk is the risk that a counterparty will fail to deliver its obligation after the party has made its delivery. Thereafter, we have the operational risk. Describe the potential relation between the operational credit and the market risk. Operational credit and market risk are interrelated. A bank suffers significant losses, and due to occur, can losses change in the credit rating for a firm and reduction in the market price for its securities. So in this way, you can relate operational risk, credit risk, and market risk. We can also share one more example. If you fail to deliver your goods in time due to machine disorder, that is a part of operational risk. And due to late delivery, your settlement may not able to meet your settlement in time with the bank. That is a part of your credit risk. Due to non-timely meeting your financial obligation, bank will change your rating and increase your interest rate. That is one of the example of the market risk. In this way, you can interrelate operational credit and market risk with each other. Describe the model and its sources. Model risk is the risk of the loss due to the use of the misspecific and misapplied model. Describe people risk. Relate to the risk associated with the fraud. Preparated by the internal employee and or external individual, describe the legal risk and its sources, loss in the value due to the legal issue, including the legal suit, fine, and the penalty or damage. Thereafter, risk measurement tool, it include the national amounts and sensitivity measures. Provide the useful intuition of the risk, not provide the consistent estimate of the potential for downside loss, the portfolio, fail to take into account difference in the volatility across the market, correlation across the risk factor, as well as the probability of adverse move in the risk factor. So it's the further explanation that we will discuss in the following video. See you again with the upcoming video. Thank you very much.